Hello, everyone. Starting on time for probably the first time in a very long time. This is David Hittle with the David Hittle Real Estate Show. My name, the host, as always, David Hittle with United Real Estate Louisville. And it is an honor and a privilege to be back with you this Sunday. It's playoff season for football, which is what I was doing prior to stepping into the office. I was watching some football, but the show must go on, and the show is here, the David Hittle Real Estate Show, and I bring it to you every Sunday at 2 o'clock, and I'm not going to disappoint you this time by not bringing it to you because of football. That would be wrong. That would be wrong of me to do to all of you. So, if you like this show, which hopefully you'll know here soon, please give me a thumbs up. This is the December 2020 housing market report. We know that 2020 was a good year for real estate, so we get to look back on it today and find out whether it was just an okay year or whether we actually did pretty daggone good in 2020. If you like shows like this, if you are interested in real estate, housing, you want to just keep up with the market, please hit that subscribe button. It is in the lower right-hand corner of the video. This is live, so if I sound like I'm rushed, it's because it's live. It's not pre-recorded. I don't have like a set amount of time, so I'm rushing through things. But please subscribe to my YouTube channel. So Showing Time is an organization. It's actually an app that realtors have, and it basically schedules them showings at different properties. So Showing Time's positive takeaway from 2020 is, quote, market data has always been a powerful tool for real estate, but 2020 marked a new high point for how data was leveraged to encourage informed decisions and to help real estate professionals reinforce their status as market experts. We don't want to just be known as buying and selling homes. We want to be known as market experts. And if we are market experts, which we should be, then we should have this sort of data at our hands. So home price appreciation, the 6 years leading to the housing crash, which was 2000 to 2006, saw home prices increase from as little as 6.3% to as high as 12.5% in 2004. The last 6 years, we have seen increases in housing prices, but nothing like we saw the 6 years leading up to the crash. We had as low as 4.4% and as high as 6.4%. It's never gone higher than that in the last 6 months. Months of inventory back then, right before the housing market crash, we were in a seller's market, very similar to today. But as soon as the housing crash occurred, we immediately jumped into a buyer's market. And that was because a lot of homes were foreclosed on. A lot of homes had to do immediate short sales, and therefore there was a lot more inventory on the market. Today, we're in that seller's market, and we're not increasing our inventory at all, which is also a good idea for home sellers anyway. It's a good idea. For home buyers, it's bad because that means that there's less inventory, less homes for them to go and see. Total home equity that was cashed out. So think about that. They and it was by refinancing. So they did a cashback refinance, and we're comparing before the crash to today. So the total home equity cashed out by refinance, and this is in billions of dollars. Back then, 2005, $263 billion. 2006, $321 billion. And then after the crash, 2007, $240 billion. Today, look at 2017, $71 billion. 2018, $87 billion. 2019, $89 billion. It's not those huge figures that we were looking at before the crash, which means that a lot of people are not doing a cash out refinance, and that's a good thing. That may mean that they're looking to sell their home soon, or it may mean that they just don't want to add on to debt, because that's what a cash out refinance is. You take your equity, what you owe minus what your home is worth, you take that out and you get cash. That cash you can use to do whatever you want with. But what you took out is added to your mortgage. It's more debt. You've added debt onto debt that you already had. That's a cash out refinance. What happened in the crash was people had done that. They had taken out their profit because their home value had greatly increased. And for instance, say their value of their home was $200,000. So they took out, and maybe they had paid off, maybe they were down to like $50,000 that they had left to pay on. So they took out a cash out refinance of $150,000. So now they owe $200,000 on a $200,000 house. But when the market crashed, when the housing market crashed, that $200,000 home was not worth $200,000. That $200,000 home was worth a lot less than $200,000 because of all the inventory on the market and because of all of the other stuff going on in your neighborhood. If a whole lot of homes in your neighborhood start to get foreclosed, that impacts the price of your home. If other homes in your neighborhood are selling for way less than what you just got money for, then your home is no longer worth that. So that causes the crash. Of all the homes in America, 58.7% have at least 60% equity right now, and that's great. That means that a homeowner right now, 58.7% of homeowners have 60% of their home's value in equity. So say their house, they had a mortgage on their house of $100,000, but they only owe $40,000 more. That 60% is their equity. It's what their home is worth, $100,000, minus what they still owe, $40,000. 60% is equity. And the American people are sitting on a tremendous amount of equity. The average equity of a mortgaged home in America is $177,000. $177,000. So what did home prices do over the last 5 recessions? Because we were in a recession. Hopefully we're starting to get out of that recession. A recession caused by the pandemic and economic slowdowns that were caused by that pandemic. But over the last 5 recessions, in 2008, home prices dropped almost 20%. Almost 20%, 19.7% in 2008, the last big economic recession, home prices dropped 19.7%. The recession before that, 2001, home prices actually increased during that recession, and they increased on average 6.6%. 1991, the recession before that one, home prices dropped 1.9%, so almost 2%. 1981, the recession before that, home prices increased 3.5%. And then in 1980, the recession before that, home prices actually increased 6.1%. So that is very pointed. That shows you that not every time there is a recession do home prices collapse. Home prices and your home in general is one of the safest investments you can have. And it is the only investment that you can live in while you own it. You can live in your home while you still pay for that investment. But what happened in 2020, the last recession? The recession of 2020, home prices in 2020 increased 7.3% on average. So, looking at the last 6 recessions, 4 of those recessions saw price increases rather than price decreases. And in 2008, we can somewhat blame that recession on the housing crash, which occurred in 2006. So, those are important figures to have, and that is why it is great to have a realtor with the heart of a teacher that will explain this and can explain it in a way that is understandable. So think about the growth of home equity. Frank Nothaft, the chief economist at CoreLogic, says, quote, over the past year, strong home price growth has created a record level of home equity for homeowners. The average family with a home mortgage has had $194,000. That's almost $200,000, folks, in home equity in the third quarter of 2020. This provides an important buffer to protect families if they experience financial difficulties, and is one reason for the generationally low rate of foreclosures. Think about it that way. You think about stocks, bonds, mutual funds, gold, silver. They are a hedge against financial difficulty. If one of the parents in the family, they lose their job and they need to get into their savings, they can sell their stocks, they can sell their bonds, they can sell their mutual funds, they can sell their gold, they can sell their silver in order to buffer them from financial difficulties. The same goes for the equity in your home. If you are not playing around with that, you think about the average family has a home mortgage with $194,000 in home equity. If one of those individuals loses their job and they need a bit more financial security, then they could do a cash out refinance to where they have a little bit of savings or a little bit of cushion there to protect them from the economic uncertainties that come with job loss, financial situations such as that. It is always good to have multiple layers of buffering and multiple layers of protection. Very important. Look at these 4 facts. 4 facts. American home equity has skyrocketed. $17,000. That's the average gain in equity of mortgaged homes. 194,000. That is the current average equity of mortgaged homes. 38.2%. That is the percentage of homes that are owned free and clear. All they got to do is pay the taxes. And 10.8%. That is the increase in equity totaling over $1 trillion. So if you take all of the home equity that Americans have in their homes, it will total over $1 trillion. But what about where you live? Look at Kentucky. That's where I live. That's where I assume most of you live. The year-over-year equity gain in Kentucky, $10,000. So here in Kentucky, the year-over-year equity gain was about $10,000. Now you got those really nice places like Washington, where home equity increased $36,000, or California, where it increased $34,000, or Idaho, where it increased $29,000, or Arizona, where it increased about $28,000. Virginia, a state that borders us, went up $22,000. Indiana, $15,000. Ohio, $13,000. Illinois, only $6,000. Tennessee, $15,000. Missouri, $15,000. Virginia, $22,000. Pretty good gain there. The United States, as an average, about $17,000 is the average equity gain year over year, and we're talking about 2020. Frank Martell, president and CEO of CoreLogic, says the housing market has remained a strong pillar in an otherwise tumultuous economic year. You think about that. We had a recession. The stock market fell. Gold prices fell. Silver prices fell. The cost of oil fell. A lot of our daily economic activity was impacted because of the recession, except for housing. Because of the record low interest rates, the bolster in home equity, many people are now having to spend a lot more time at home. They may feel trapped at home. The home that they're now stuck in way more than they were before, it may be way too small for them. And now they are looking at ways to increase their net worth. The best way to increase a person's net worth is through home ownership. I've told you the statistics before. The average homeowner has hundreds of thousands of dollars in net worth versus a renter that may have thousands on average. The average renter is not saving a lot of money, or they may be saving money in a savings account, but it's not a lot compared to their personal net worth, because a home, once you purchase a home, becomes part of your net worth. It is a type of forced savings. You pay that mortgage and your equity increases. It's amazing. It is amazing. Home ownership is part of the American dream, and that is very understandable. So where do we go from here? The next 6 years, or the next 5 years? Oh, 6 years, yeah. Next 6 years. The Home Price Expectation Survey, which is what experts predict home prices will be in the coming years, shows this. If you purchase a $300,000 home in January of 2021, okay, a $300,000 home in January of 2021. The experts predict, according to the Home Price Expectation Survey, predict that by 2022, your $300,000 home should be worth $313,200 by 2022. By 2023, $324,162. By 2024, $333,887. By 2025, $343,903. And by 2026, 5 years after you bought this home, this month, this year, January 2021, the Home Price Expectation Survey, the experts predict that your home will have gone from $300,000 in January of 2021 to $354,221 in January of 2026. So over the course of 5 years, the Home Price Expectation Survey of experts predict that your home will increase on average $54,221 over the course of 5 years. And you think about if you have paid off, say on that $300,000 home, you paid off, say, $30,000 over the course of those 5 years, then your $54,221 home is going to be worth even more because you are going to have a split in equity there too. So your home, if you were to pay off $30,000 in that 5 years, would actually be worth about $84,000 versus $54,000. And these numbers are just an average of the entire country. We have seen here in the Louisville Lexington market numbers that are higher than this in just 1 year. Absolutely amazing. Almost $40,000 year over year versus last year here in the Louisville Lexington market. So home equity, home values, that is what is driving our economic system. So what's ahead in 2021? David Melly, the president of Homes.com, says that the surge in the work-from-home population has completely rewritten the playbook for many home buying and rental decisions, from when and where to relocate to what people are looking for in their next residence. Mark Fleming, the chief economist at First American, says that despite the best intentions of home builders to provide more housing supply, the big short in housing supply will continue into 2021 and will likely keep house price appreciation flying high because there's no inventory. Here in the Louisville Lexington market, we hit 1.4 months. That is danger low. 1.4 months worth of inventory. When I started in real estate, we were at about 3 months, 3 to 4 months of inventory. We're at less than 1.5 months of inventory. The home builders are trying to keep up, but they cannot. My favorite home builder is selling homes before they can even be built. That's how fast homes are flying off the market. So with the supply being low, it's the supply and demand argument. The supply being low, demand being high, home prices will increase. And I believe that demand stays high as long as we have low interest rates. And this week, we had a brand new record low interest rate at 2.65%. So here are the experts. The 2021 housing price forecast. These are the experts. The National Association of Realtors forecast a 6% increase in home prices in 2021. Zelman, 6% increase in home prices in 2021. Realtor.com, 5.7. CoreLogic, which at the beginning of this year said that we forecasted that 2021 was going to see negative 4%, now says that they are forecasting 4.1%. Freddie Mac, 2.6. Fannie Mae, 2.1. And MBA, 2%. So all of the experts are predicting home prices will continue to increase. Realtor.com says the bright spot for buyers is that more homes are likely to become available in the last 6 months of 2021. And that should give folks more options to choose from and take away some of their urgency. So, if you are a home buyer and you're currently on the house hunt, but you can't find anything, Realtor.com is predicting that the last 6 months of 2021, there should be more inventory. But all the experts are saying that home prices are going to continue to go up. So, waiting until the last 6 months of 2021 may mean you pay more for that home than if you were to purchase one today. The dollar, more depth, less length. So this great recession, people were thinking that it may be a U-shaped recovery to where we started up here, which we did in February, March of 2020, and we were going to come down here and we're going to stay down here for a while, and then we were going to pop back up eventually, a U-shaped recovery. That's not what happened. From this graph that I have here, it's amazing. It is a beautiful graph. It is a strict V. Compare that to the Great Recession of 2006 to 2016, where it started here and it rolled off and then stopped at the bottom and then slowly rolled up again, but it was very slow. Or what the Federal Reserve predicted for this time, they predicted this way different than that. V versus a slow roll off. The Wall Street Journal predicted something very similar. But we look at unemployment. Unemployment, which was way above 15%, we're currently at 6.7, which is actually phenomenal. Experts predicted there was no way we were going to get below double digits before 2020 was over. They did. The projections for unemployment in 2021, 5.6% and 5%. So they're saying unemployment's probably going to stay higher than we'd like anyway. 2022, 4.8% and 4.2%. And 2023, 4.4 to 3.7. Around that 3 level is where we were prior to the economic crisis. Young Hyun Chow, I may have totally butchered that, but he or she is the research associate with the Housing Finance Policy Center at the Urban Institute, states that renters are disproportionately hurt by the crisis. That's true. People that are renting are disproportionately hurt by economic downturns, by economic crises like the one we're seeing. A greater share of renters lost their jobs. That means losing savings that could have been used for a down payment, falling behind on bills, which will hurt their credit and make it even more difficult for them to be future home owners. And that's another thing. When you are renting a home, not only does the price that you have to pay, the monthly payment or the monthly payment over the course of years go up normally. It's very rare that you see rent prices go down. It happens, but it's very rare. But not only do they go up every year, or most years, but you are paying someone else's mortgage. So that your landlord or whoever owns the property is earning the equity that you would be earning if you owned a home. Another thing is if you went ahead and bought the home and say you lost your job, you fell behind on bills, and your credit starts to go down, it doesn't matter. You already own your home. Your lender can't be like, "Oh, well, you're a bad risk now, so we're going to increase your mortgage payment." They can't do that. Renters, they can do that. Landlords can do that. "Oh, you're not as good a risk anymore, or you're a higher risk now, so we're going to need to increase your rent." And they do it for whatever reason they feel like it, really. For each of the following possible post-forbearance options, what percentage of these 2.7 million homeowners do you estimate will, and this is the home price expectation survey again, 58% of those in forbearance will resume their mortgage payments and stay in their home for at least a year. 24% will list their home within 1 year of the exiting forbearance. And 18% will receive a foreclosure notice within 1 year of existing forbearance. That would be about 486,000. That's way too many. So the issue is the government implemented forbearance policies so that individuals would not be losing their homes, or all 2.7 million of these individuals losing their homes. But 1.57 million of them will resume their mortgage payments and stay in their home for at least a year. And 648,000 will probably list their home within 1 year of exiting the forbearance. Either they are downsizing a home, or maybe they are getting into a newer home, or maybe even a bigger home, but with a lot less mortgage interest rate, which is a great idea. Frank Fratantoni. Okay. The chief economist at MBA, the Mortgage Bankers Association, says that Treasury rates have really been moving up since the election, but mortgage rates have kept going down. We're going to start to see mortgage rates drift up with Treasury rates, as opposed to moving in the opposite direction. And that could definitely be the case. The incoming president, President Joe Biden, has indicated that he would like to see home buyers receive a $15,000 either tax credit or housing grant. If that is to occur, then home buyer demand is going to even more skyrocket. Think about when, I believe it was President Barack Obama, did the cash for clunkers. If you had an old car and you wanted to get rid of it, the government was giving you more money as a tax credit if you got rid of your old junky car. Same thing with this. If the home buyers are going to receive a $15,000 grant, then that is going to be a great down payment for a lot of people, and it will cause home buyer demand to skyrocket. And if it is for all home buyers, not just first-time home buyers, but if it's for all home buyers, then you will see demand skyrocket even more, because people will sell their houses to buy a new one with a $15,000 grant. So they'll cash out the profit from their current home and pick up an additional $15,000 when they go to buy their new one. That would be a great time for the for the housing market, especially. Think about it this way, and this is important to realize. Today, on a $300,000 mortgage at a 2.7% interest rate, your P&I, which is your principal and interest payment, is $1,216.79. By the end of 2021, your mortgage being, if you waited to buy your home, the home would go up to the it gets confusing, but follow me here. The home price went up. So your home that you would have bought today at $300,000, you're going to have to pay $317,100 in the end of 2021. Excuse me. There's always two. So the end of 2021, you've waited. You didn't buy a home. The price of the home has gone up from $300,000 to $317,100. But so too has your interest rate. The interest rate they are predicting, this is Realtor.com's prediction, interest rate's gone up to 3.4%. So you were going to pay today $1,216.79. But at the end of 2021, you'll wind up paying $1,406. That is an increase in your monthly payment of $189.21. Doesn't seem that bad, right? But over the life of a 30-year loan, that increase of $189.21 is an increase of $68,115.60 over the lifetime of your loan. Oh my good golly gosh. Jessica Louch, the Vice President of Demographics and Behavioral Insights at the National Association of Realtors, says, and I quote, "I do believe that the American dream of home ownership is very strong. It's very much alive from all the survey data that I've seen. If you are not a homeowner, you want to be one in the future, whether that's a short-term goal or a long-term goal." And that's true. Most people want to be a homeowner. So here's what I'll say. If you, like the survey data says, want to become a homeowner, now is the time to be moving on that. You do not want to wait until the end of the year where home prices have already increased, mortgage interest rates have already increased. You do not want to wait for that. Waiting for that would be a very bad idea. Because if you wait for that, you are going to pay a lot more than what you will pay today. Just take that, for instance, that I gave you. A $300,000 home today, 2.7%. You're going to pay $1,269. Wait till the end of the year. That same $300,000 house is now $317,000, and you're going to pay $1,400 a month for your mortgage. $68,000 over the lifetime of that loan. Don't risk it. Do not risk it. Home buyer demand is still going, but it is lower than where it was in the summertime. Home buyers don't like the cold very much either. If you're looking to sell your home, now is the time. Sell it today and get going on your new home. Get into a new home with a new lower interest rate. If that is your goal, if a new home is your goal this year, if getting into your first home is your goal this year, do it now. Start moving now. Start looking now. Get pre-approved today and get in contact with a realtor that will walk with you every step of the way. Do that today. If you'd like to get a hold of me, my contact information is all in the description of this video. I'll see all of you next Sunday. Enjoy 2021. It's going to be a bumpy ride.